Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds, and I am going to start off today's video by asking you a question. What is better? Investing your money through a traditional IRA or investing your money through a Roth IRA? Now, you will hear people say, well, a traditional IRA is better because your money goes in pre-tax, meaning you don't pay any tax on it before you put it into this investment vehicle. And then number two, it grows tax-free, or really that means it grows tax-deferred until you take the money out of this investment vehicle. So it goes in before you pay any tax, and then it grows tax-free for the whole time that you leave the money in this investment vehicle. On the other hand, you will hear people say, well, a Roth IRA is better because even though you put your money in after tax, meaning you pay tax on your money first, then you put it into this investment vehicle right here, even though you put your money in after tax, you will never have to pay tax on it again, including the investment earnings, right? With a traditional IRA, you put the money in pre-tax, but both the original amount that you put in, the contributions, plus the investment income, even though it grows tax-free, eventually it will be taxed, all of it, when you take the money out. On the other hand, with a Roth, you pay the tax up front, then you never have to pay the tax again, including on all of the investment earnings. So which one is it? Traditional IRA or Roth IRA? That is the question for today. And in this video, I am going to show you an example of how you can save tens of thousands of dollars and potentially even hundreds of thousands of dollars or more over the course of your life if you know how to properly use these two investment vehicles. But the first thing that you need to understand, which may shock you because a lot of people don't actually understand this, is that investing through a traditional IRA versus a Roth IRA is exactly the same as long as your tax rate remains the same throughout your life. Let me say that again. Okay, there is no difference between investing through a traditional IRA versus a Roth IRA as long as your tax rate stays the same. So then, how do you use these investment vehicles to save taxes and ultimately put more money in your pocket over the course of your life? Well, I am going to show you exactly how to do that. So grab yourself a cup of coffee, kick back, and let's start crunching the numbers. And if you enjoyed this video, please like and subscribe and let me know in the comments what other tax planning topics you'd like to see me make videos about. Let's begin. All right, the first thing is to understand why traditional IRA and Roth IRA are the same if your tax rate stays the same. In order to understand how to use these two investment vehicles to benefit you, you first have to understand why there's no difference between them if your tax rate doesn't change. So let's do an example. Let's compare investing $5,000 per year in both kinds of IRAs. So in this example, the income available to invest before tax will be $5,000. We're going to assume a simple flat tax rate of 25% just to make the math easy, which would mean that income available to invest after tax would be $3,750. In other words, you could invest $5,000 before tax, or you could pay 25% of this $5,000 in tax now, and then you could invest $3,750 after that tax was paid. So those are your two options, right? Before tax is going to be your traditional IRA. After tax is going to be your Roth IRA. So let's go down here to these two columns. So year one contribution. If you go with the traditional IRA, which is going to be in this column here, you're going to put $5,000 in pre-tax. On the other hand, if you go with the Roth IRA, you're going to put in $3,750 after tax. Those are the numbers that we got from up here. Okay? We're going to just assume a rate of return of 10% annually. Okay, now remember that this is just an investment vehicle. This is just an investment vehicle. The actual underlying investments, like the stocks, the bonds, the mutual funds, whatever you actually choose to invest in, that can be the same between this one and this one. So the rate of return is the same on either one. It doesn't matter which one you go in. You can get the same rate of return because you can invest in the same things. All right. The question really is investing pre-tax or investing after tax. Okay, so 10% rate of return on $5,000, meaning at the end of year one, you would have $5,500 sitting in your traditional IRA. On the other hand, Roth IRA, you had $3,750. If you get 10% return, that means at the end of year one, you're going to have $4,125 sitting in your Roth. Okay, now let's go to year two. Year two contribution, you put in another $5,000 into your traditional. $5,500 at the end of year one plus $5,000 additional contribution year two equals $10,500 total before you calculate the investment return for the year. 10% rate of return, so $10,500 times a 10% rate of return gives you $11,550 at the end of year two. Everyone following so far? Roth IRA, you had $4,125 at the end of year one. You put in another contribution of $3,750 for year two. The total of $4,125 plus $3,750 is $7,875. Multiply that by a 10% rate of return. That gives you $8,663 at the end of year two in your Roth IRA. Okay, so what is the rate of return is the same. With the actual underlying investments, the stocks, the bonds, the mutual funds, those are all the same. The difference is traditional IRA, I'm putting in the money before paying tax. Roth IRA, I'm putting in the money after paying tax. Okay, now we're going to expand this to multiple years, but I'm going to speed it up because I'm not going to make you sit through every single year. Okay, so look right here. I've taken $11,550, which is this number right here, cell F19. I add $5,000 to it. Every year I'm putting an additional $5,000 into my traditional IRA in this example. Very common thing to do. People make the same contribution year after year after year. Multiply that total, $11,550 plus $5,000, multiply that by 1 plus 10%, that's how you increase something by a percentage, 1 plus whatever percentage you want, in this case 10%, we get $18,205 in the traditional at the end of year two. Exact same thing over here. I take the 8663, which is this cell right here. I add another 3750, which is my after-tax investment amount. I multiply that total by 1 plus the percentage rate that I want to increase it, in this case 10%. At the end of year three, I'm sitting on $13,654 in the Roth. I understand that the total amount you can contribute to a traditional and a Roth is slightly larger than these numbers right now. It grows each year with inflation. The amount you can contribute goes up a little bit. Let's just ignore that for now. That doesn't matter. What matters, to make the math simple, I'm just putting in the same $5,000 every year into the traditional. I'm putting the same $3,750 every year into the Roth. Okay? End of year three, end of year four, end of year five, end of year six. I'm doing exactly the same thing. Just adding another $5,000 to the ending balance from the previous year, multiplying it by 1 plus a rate of return, and so on and so on. Okay, I'm going to take this away, and we're going to go all the way down to, this is going to be 20-year investment. Okay, so even in the last year, again, previous year, add $5,000 more contribution. Multiply that total by 1 plus the percentage which you want to increase it by. So at the end of 20 years, I'm sitting on $315,012 in my traditional IRA. Roth IRA, I'm doing the same thing. I take the last year's ending balance. I add another $3,750. I multiply the total by 1 plus the rate, in this case 10% rate of return. At the end of 20 years, here's the comparison. I'm sitting on $315,012 traditional, $236,259 Roth. Okay, that is how I calculate how much is going to be there at the end in this example. Now, what is the next step? Let's look at the Roth IRA first. Take this away. Here's the ending amount, the ending balance at the end of year 20. Here's the $236,259. What is the tax rate that I'm going to have to pay to get the money out of the Roth? This assumes that you've held the Roth for the requisite 5 years, you've reached the right age, etc., etc. This is a simple example where you just you contribute to these accounts over time, you invest in them over time, and then after you reach the right age, you start pulling the money out, okay? End of year 20. $236,259. What is the tax rate to get the money out of the Roth? 0. You'd never have to pay tax on the money that went in, the contributions, and you never have to pay tax on the earnings in a Roth. So 0% tax is being paid. What ends up in your pocket? $236,259. There's never any more tax paid on this. That's the Roth. Let's look at traditional. Traditional at the end of year 20. What do I have? $315 and $12. There it is right there. What is the tax rate that I have to pay to get the money out? In this case, we are assuming that your tax rate has not changed. It's 25%. Okay? It's going to cost 25% in taxes to get this money out. So I take 25% of this number away. And what is left in my pocket? $236,259. Exactly the same number that's right here. Exactly the same number that's right here. If you're trying to do the math, I don't want you to multiply this by 25%. It's this number multiplied by 75%, which is what's left. That's what's in this cell, okay? Because I've taken 25% away from this in taxes, all right? The investments between a traditional IRA vehicle and a Roth IRA vehicle is exactly the same. The return in your pocket will be exactly the same if your tax rate never changes. So when you hear someone say, well, traditional IRA is better, you hear someone say a Roth IRA is better, that person does not understand these vehicles because one is not better than the other. They are the same. The only thing that causes them to be different will be the tax rates applicable to you over the course of your life. Okay? So, what is the built-in assumption in this example that we just went through? The assumption which isn't true in real life. It's that the tax rates will remain the same over the course of your life. Okay? And in the course of your life, that is not going to be true. So if you use the tax planning that we're about to go through here in these next 3 tabs, we're about to walk through that. If you use these strategies, that is how you can potentially save the tens or even hundreds of thousands of dollars throughout the course of your life by using these two appropriately and by understanding that one is not better than the other. What makes one better than the other is what your personal tax rate is going to be throughout the course of your life. So let's check it out. All right, so how do tax rates change throughout your life? Well, the most obvious, but perhaps least important one that you may be thinking of is that tax rates will change because the law changes, right? In other words, Congress is going to change the tax law. And this happens, right? This happens all the time. But this is actually the least important one for 2 reasons. This is the one I don't want you to be thinking about because, number one, you can't control this. And number 2, often when the headline tax rate changes, like you'll hear politicians will say, well, we're changing the tax rate to this or that. Often what happens is that underlying deductions, the standard deductions, exemptions for dependents, the income thresholds to which those headline rates are applicable, all that stuff changes too. And what happens is a lot of the times the actual marginal tax that you end up paying, like the actual tax that ends up being calculated on your return, doesn't actually change that much, even though the headline rates might get adjusted over time. All right? Instead, what I want you to be thinking about is how tax rates change because of your personal circumstances and changes in income situation. Okay, this is the elephant in the room. This is the one that's going to cause you to be in higher tax brackets, lower tax brackets over the course of your life. And here are some examples of why that might be. Lower income at the beginning of your career causes you to be in a lower bracket. Higher income from promotions and raises, etc., later in your career causes you to be in a higher bracket potentially. Losses from your business when it first starts can push you down into a lower bracket. Higher income from your business as it grows over time can push you into a higher bracket. Going back to college or graduate school, maybe you stop working, you start living off of savings, you go down into a lower bracket. Getting married and now both spouses are working, maybe that pushes you into a higher bracket. You have kids and one spouse stops working to stay at home to raise the kids, all of a sudden you're in a lower bracket. Kids go to college, maybe both spouses start working again, you're in a higher bracket. Windfall income, for example, from like a home run investment, all of a sudden you're in a higher bracket. Illness or injury causing changes in your working situation or income, suddenly you're in a lower bracket. Inheritance pushes you into a higher bracket. Stock market fluctuations. Retirement causing your income to come down. Social Security income starting. RMDs, which are called required minimum distributions, which is something that you will be required to take money out of any of your investment retirement accounts. You will be required to take income out of your traditional IRA once you reach a certain age, which is in your early 70s at this point. That can cause your income tax bracket to change. Estate planning and considerations about what your beneficiaries will inherit, that can cause changes into what you do, which can cause changes in your income tax bracket. All of these life events are really what is going to cause you to fluctuate up and down through the brackets. And when you plan for this, that is how you can use these retirement vehicles, these tax-advantaged vehicles, the traditional and Roth IRA, to maximize your tax savings and put the most amount of money in your pocket. So all of these factors can cause your income and your tax situation to fluctuate throughout the course of your life. This is what we have to plan for in order to minimize your taxes and maximize the cash in your pocket after tax. So here's an example. Okay. Here is what you should consider doing. You should consider having both a traditional IRA and a Roth IRA. And what you should be striving to do is generally this. You want to contribute as much as you can to a Roth IRA in low income, and in other words, low tax bracket years of your life. Alternatively, you want to contribute as much as you can to a traditional IRA in high income years. In other words, in high tax bracket years. You want to strategically go back and forth between these two vehicles as your income and tax bracket, tax rate situation changes because of events in your life. If you do this, you can walk away with tens of thousands of dollars or even hundreds of thousands of dollars, depending on the quality of your underlying investments over the course of your life. Just by, instead of saying, this one's better, I'm only going to do traditional. This one's better, I'm only going to do Roth. No, have both and strategically contribute as much as you can to Roth in low income years and strategically contribute as much as you can to traditional in high income years. Let's do an example, and I'm going to show you how the numbers play out. Before we get into the fact pattern of this example, which I'll go through in just one second, here's what we're ultimately going to do. We're going to compare the results by just doing a Roth or just doing a traditional versus strategically doing a traditional and a Roth together. So there's going to be three different results: Roth only, traditional only, and then both combined. Okay, and you're going to see the difference between them. So here's the fact pattern for the example. Let's say Phil Smith is in the 10% bracket for the first 5 years of his career. Okay, these are going to be simplified assumptions. Obviously, based on, let's go back here real quick, based on all of these things, which could happen year after year after year, you can go up and down and up and down and up and down, and you will have to plan accordingly for your own personal situation. We're going to kind of simplify it here. We're going to say Phil is in the 10% tax bracket for 5 years, first 5 years of his career. Then he's going to move up into the 25% bracket for the next 10 years of his career. And he can move into this bracket for any of the reasons we just went through. And then he could potentially go back into this bracket for any of the reasons we just went through. But again, we're going to simplify the assumptions. And then we're going to say 35% tax bracket for the next 15 years of his career. So he's got a 30-year career. He's going to start in the 10% bracket. He's going to bump to the 25% bracket. He's going to bump to the 35% bracket. Then he's going to be in the 15% tax bracket after retirement for 30 years, and he's going to pull $5,000 out of his retirement accounts, out of his Roth and his traditional, $5,000 a year for 30 years. So he's going to put the money in for 30 years, then he's going to pull the money out for 30 years at $5,000 a year, except we're going to throw in a little wrinkle here. For 2 years of retirement, he's going to get some inheritance or something, and that's going to push him into the 35% bracket. Okay, so instead of 30 years, really he's going to be in the 15% bracket for 28 years of retirement, and he's going to be in the 35% bracket for 2 years of retirement. But either way, he's going to be pulling $5,000 out a year. Okay, so based on this fact pattern, let's see what happens if somebody says, I'm just going to do it Roth, I'm just going to do a traditional, or I'm going to strategically do both. Let's see what the results are, okay? So here's example 1, Roth only. We're going to use the same $5,000 pre-tax to invest each year. Now with a Roth, remember you invest after tax. So I'm going to take $5,000. For the first 5 years of his career, as we said, he's in the 10% bracket. That was the first bullet right here. So we're going to take $5,000, we're going to take away 10% of the money for tax, and that's going to leave him $4,500 to invest. And he's going to do that for 5 years. He's going to put $22,500 into the account. Now, for the next 10 years of his career, he's bumped into the 25% bracket. Okay? He's still going to invest $5,000 pre-tax, but Roth is an after-tax investment, so he's going to take 25% of this number away in taxes, leaving him with $3,750 to invest after tax. He's going to do that for 10 years. He's going to put $37,500 into this Roth. And then for the final 15 years of his career, he's going to still invest $5,000. He's going to take 35% away up front in taxes, leaving $3,250 to invest for 15 years, puts $48,750 in the account. Okay, this total right here is $108,750. Now, what have I ignored? I've ignored investment return. Okay, investment return doesn't matter because it can be exactly the same between a Roth and a traditional. But I'm going to layer it on at the end just so you can see the dramatic effect of these numbers. But I want you to remember from the original example, the actual investment return can be identical between the Roth and the traditional. So it doesn't matter. It doesn't matter which one you use. The only thing that matters is how your tax rates fluctuate over time. The actual investment return doesn't matter because that's going to be the same regardless of what investment vehicle you use. So we're going to ignore that for the moment, and we're just going to focus on the contributions and ultimately the distributions, and I'll layer on the investment return at the end. So in this scenario, okay, he paid the tax up front. This was the amount that went in. So at the end, he's got $108,750 in his pocket. And why is there no tax on the way out? Because Roth pays the tax up front. So this never gets taxed at the end. Okay, the money coming out never gets taxed, including the investment income if we had put any in here. None of it gets taxed. This comes out tax-free, $108,750. Now let's go to the next example. Okay? This is traditional only. Traditional only goes in pre-tax, so there is no tax rate and there is no after-tax amount. We don't care about that for traditional. He takes his $5,000, he puts it in for 5 years, that's $25,000. He takes his $5,000, he puts that in for the next 10 years. That's $50,000. It's all tax-free. It goes in tax-free. $5,000, he puts that in for 15 years, $75,000. At the end of the 30 years, he has $150,000 in his traditional. But it gets taxed on the way out, okay? So here, tax on withdrawal. He withdraws $5,000 per year, we said. And remember, he's in the 15% bracket during retirement for 28 of his 30 years. Because remember, we said for 2 of his years, he's going to get bumped up. 2 years, he'll be bumped up due to an inheritance in the 35% bracket. So for 28 years, he pulls out $5,000 at the 15% rate, and he pays $21,000 in taxes on that. And for 2 of his retirement years, he pulls out $5,000 at the 35% rate. He pays $3,500 in taxes. So $150,000 minus $21,000 minus $3,500. He has $125,500 in his pocket at the end. That is the exact same fact pattern as the Roth. But with the Roth, he only walked away with $108,750. Why? Why? If you're not seeing the difference, pay attention why. Because in the Roth, he paid the tax up front at these rates right here. He paid 10% for a while. Then he paid 25% for a while. Then he paid 35% for a while. And so he was paying up front at these rates. With the traditional, he wasn't paying anything up front. Instead, he put it all in tax-free, and he paid at 15% only for 28 years and 35% for 2 years. Okay, so instead of paying 25 and 35 for 10 and 15 years, he paid 15% for 28 years. That's why in this example, because of how this person's tax rates changed over the course of their life, he walked away with $125,500 in his pocket versus $108,750 in his pocket just by picking one investment vehicle over the other. The actual underlying investments are the same. Okay, now let's look at the third example, strategic mix between a Roth and a traditional. So what Phil is going to do here is he's going to say, all right, in my early years, when I'm in a low tax bracket, I'm considering 10% to be low. In my early years, I'm going to pay the tax up front and contribute to a Roth. So I'm going to take $5,000 times I'm going to take away 10% because I'm paying tax up front. That leaves me with $4,500 to invest. I'm going to do that for 5 years. I got $22,500 in my Roth. But in my later tax years, when I'm in the 25% bracket and I'm in the 35% bracket, I'm going to switch. I don't want to contribute to the Roth anymore. I'm in a higher bracket. I'm going to contribute to my traditional instead. So I'm not going to pay the tax up front. I'm going to put in $5,000 for 10 years, tax-free. Tax deferred is really what it is. $50,000 total. I'm going to take $5,000. I'm going to put it in for 15 years. That's $75,000 total. Add these two together. That's $125,000 in my traditional. Then I'm going to, now remember, when the money comes out, I'm going to have to pay tax on it. And remember up here, I said for 28 years, Phil is going to be in the 15% bracket. And there's going to be 2 years when he's in the 35% bracket. So what he can do is he can strategically withdraw the money between the traditional versus the Roth, depending on what bracket he's in. Okay, so he's got 25 years worth of withdrawals to take out of his traditional, and he's got 5 years of withdrawals to take out of his Roth. So during these 2 years when he gets bumped into the high bracket, he's going to strategically pull the money out of his Roth for no tax implications. But during the lower rate years, when he's in the 15%, he's going to pull the money out of his traditional. So for 25 of the 30 years, he's going to strategically pull this money out at 15%. And during the other 5 years, which includes these 2 years where he got bumped up because he can strategically make this choice, he's going to pull it out of the Roth in those years and pay no tax. So for the traditional, he's paid 15% on $5,000 for 25 years, $18,750 in tax. That leaves him with $106,250 after tax in his pocket. This comes out tax-free, $22,500. So you take this number, you add it to this number, and he walks away with $128,750 in his pocket at the end of the 30 years. $128,750, versus $125,500, okay, versus $108,750, okay? The only difference was that he strategically contributed and distributed the money from traditional versus Roth based on the tax rates that were applicable to him over the course of his life. He didn't just blindly say Roth is better, traditional is better, because it's not. It's the same. What's different is what actual rate is applicable to you in each year of your life. And if you strategically contribute and distribute from these vehicles, you can maximize the amount that ends up in your pocket at the end of the year. At the end of your life, throughout the course of your life. So let's make this even a little bit more dramatic, because remember, I have not added any investment return to this, but the investment return in all of these scenarios can be exactly the same. The underlying investments can be the same. So what if we consider this? Let's just add one more zero to the end of these three choices, okay? Because all of these can grow at the same rate. So here was my original amount in the Roth, $108,750. Tack on a zero to that. That's $1,087,500 over the course of 30 years in a Roth. My original traditional only result was $125,500. Tack on another zero to that. Traditional is having $1,255,000 sitting in that account at the end of your life if you strategically, if you only do the traditional. But if you strategically do the mix, okay, the original result was $128,750. Tack on a zero to that. $1,287,500 in the strategic mix. This number, $287,500 versus $255,500, that's $32,500 more. You made $32,000 more over the course of your life by just being smart about putting it between this vehicle and this vehicle instead of blindly just putting it into one. This number is $200,000 bigger than this. If you have a portfolio worth $1 million, I have never met someone with a portfolio worth $1 million that says that $200,000 isn't a lot. That is a significant difference. That is a 20% difference between $1,087,000 and $1,287,000. Okay? $200,000 difference over the course of your life. That's $200,000 extra in your pocket over the course of your life for doing nothing more than, instead of blindly going with this one or blindly going with this one, you strategically contribute and withdraw to both. The underlying stocks, bonds, mutual funds, investment strategy, whatever, is all the same. The difference is how you contribute and distribute over the course of your life based on the tax rate. So here is a summary matrix that I created for you to just understand. In your contribution year, as a general statement, if your tax rates are low, if you're in a low bracket, if you're low income, contribute as much as you can to a Roth. The Roth pays the tax in the contribution year, so contribute when your rate is low. On the other hand, in your contribution year, if you are in a high bracket, contribute to a traditional. Traditional defers the tax in a contribution year, so contribute when your rate is high. Alternatively, on the flip side, in a distribution year, if you're sitting in a low tax rate or you have low income in a distribution year, distribute from the traditional, because the traditional pays the tax in the distribution year. So distribute when your rate is low. And finally, in the distribution year, if you are in a high rate for whatever reason, distribute from the Roth, because the Roth pays no tax in the distribution year. So distribute when your rate is high. If you strategically do this, you can save tens of thousands, even hundreds of thousands of dollars in your pocket. You can save that in tax and put more money in your pocket by strategically using these tax-advantaged investment vehicles, as opposed to blindly saying this one is better, because they're not. What makes them better is your specific tax situation. Thank you for watching. I hope you enjoyed this video. If you did, please like and subscribe. Let me know in the comments what other tax topics you'd like to see. Catch you in the next video.